So, silver just crushed everything this year. It didn't just rally. It effectively became the third most valuable asset class in the world, sending shockwaves through trading desks everywhere. And right in the middle of this chaos, China just did something very strategic. They effectively stopped selling silver. Why? To understand the gravity of this, let me zoom out and explain this from the context of gold and silver, because they are playing two very different games. Gold is about bringing back the trust in money. It is about the reserve currencies and what backs them, which in China's case is going to be gold. That is why China spent the last few decades quietly building the Shanghai Gold Exchange. They are expanding what insiders call the gold corridor, and they are publicly buying as much gold as they can get their hands on. They are doing this to signal to the world, hey, if you want a monetary system outside the control of the US dollar and the US empire, this might be the solution. A money that is backed by gold, stored in your countries, if you want, or in ours. One which we will consider compliant with Basel III standards, meaning you can finally use it as a Tier 1 asset, collateral to borrow money from us if you want to build your country's economies. Okay, so that's the gold story. Now, silver plays a very different role here. Silver is not about trust in money. Silver is about controlling a very important resource that makes the modern world work. And that is because silver is used in absolutely everything. We are talking about solar panels, electric vehicles, data centers, military-grade electronics, satellites, literally everything. It is scientifically considered the single best electrical conductor on Earth. But unlike gold, when silver gets more expensive, industries do not stop buying it. They can't just wait for the price to come down because they have to use it to finish their products. This leads to one of the biggest theories about precious metals, that for the last few decades, their prices have been deliberately suppressed and controlled to remain as cheap as possible for as long as possible to subsidize global industry. But over the next decade, the demand for silver is expected to explode because of all these applications like AI, robotics, and the green energy transition. Everything that the government wants control over. And because China now controls most of the refining, the processing, and now the export rules, China will have a huge say in who gets access to this critical material and who gets cut off. So this story is a lot bigger than silver just going up in price and beating the S&P 500 this year. I want to break down exactly what China just did with silver and how all of this fits into the bigger picture of the US-China rivalry. This impacts global markets and investors, and even people who don't own a single ounce of silver. So with that said, let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the silver. Okay, so here's a very simple question. How does anyone actually know what an ounce of silver is worth today? We know the price because of something called markets, right? This is where a mechanism called price discovery happens. And while there are a lot of silver markets around the world, from London to Tokyo, the two that really matter, the ones that act as the heartbeat of the global price, are the COMEX and Shanghai. The COMEX is the main US futures exchange, and traditionally, it is where global prices are discovered. Most people trading here are massive entities, miners hedging their future production, manufacturers locking in costs, or just Wall Street traders speculating on the spread. That is the COMEX market. But here is where it gets technical. Inside of COMEX-approved vaults, silver is strictly split into two very different categories. The first is eligible silver. This is metal that meets the purity standards but belongs to someone who is just using the vault for storage. It is explicitly not for sale. The second category is registered silver. This is the inventory that actually matters because it is available for immediate delivery if a trader wants to settle their futures contract by taking the actual physical metal. But there is a glaring problem with this setup. Right now, the COMEX only has about 120 to 130 million ounces of registered silver. That is the entire buffer available to settle transactions. To put that in perspective, that amount is only about 10% of the annual global demand, which sits at roughly 1.2 billion ounces a year. And that means if every trader holding a paper contract suddenly lost faith and demanded delivery of their physical silver at the same time, the exchange would simply break. They would not be able to fulfill the orders because less than 10% of the metal is actually there to be taken. You see, the COMEX was never really designed to be a supply store for the world's physical silver needs. It was designed as a hedging venue. It works for now only because most contracts are just rolled over to the next month, and most trades are cash settled. Most investors just want the profit. They don't want a 1,000-pound pallet of metal delivered to their front door. Okay, so why does that matter then? Well, it matters when psychology shifts, when the behaviors of people change and they stop trusting the paper and start demanding the metal. And that means we realize we need more silver because we don't have enough liquid supply. So what do? Well, this is exactly where the Shanghai market comes into play. You see, Shanghai's silver prices are actually trading higher than COMEX prices. This is because Shanghai markets reflect the cost of actual physical delivery inside of China, whereas COMEX prices are increasingly seen as just paper prices. So when Shanghai trades a couple of dollars above the COMEX, that is a warning signal. It means the value of guaranteed, in-your-hand physical silver is rising significantly faster than the value of the paper promise. And let me show you exactly how this just played out in real time. On December 24th, physical silver in the Shanghai market closed at approximately $78 an ounce. At the exact same moment, silver on the COMEX market, which, remember, is the main Western futures market for paper silver, closed at just $72 an ounce. That is a massive gaping spread of about $6 per ounce. Historically, that kind of price difference is unheard of. In a functioning global market, the premium between these two exchanges is usually pennies, rarely more than $1. Why? Because of a mechanism called arbitrage. The concept is simple. Traders see that silver is cheap in New York and expensive in Shanghai. They buy the cheap silver, ship it, and sell it where it's expensive. That buying pressure here and selling pressure there forces the prices to converge. Professional arbitrage traders and their high-frequency algorithms normally erase those premiums almost instantly. They buy the discount, sell the premium, move the metal, and the gap closes. But when you see a $5 or $6 gap staring you in the face, and it stays there for hours, especially during a low liquidity holiday season like we just saw, it tells us that the arbitrage mechanism is broken. It tells us that physical silver is not moving freely. Remember, Shanghai pricing reflects what it actually costs to get your hands on deliverable physical silver inside China. The silver needed for solar panels and electronics. COMEX prices here in the West, by comparison, are reflecting a financialized market where most contracts are never delivered. They are just settled in cash. Under normal conditions, these two systems stay linked. But when they start to split and you get these huge disconnects, it is a sign that the physical supply is becoming constrained or functionally trapped. This chart shows the total silver held in COMEX-approved vaults. This data includes both the silver that is eligible and the silver that is registered. Over time, the trend is undeniable. Physical silver has been relentlessly flowing out of Western vaults, not building up. Historically, when registered inventory starts to get this tight, that is when physical silver breaks away and becomes more expensive than the paper price. It is almost like China's market is forcing the Western market to face reality and reprice silver higher. Okay, but why is this happening now? So, I talk a lot about staying invested in the market, but I almost never talk about the other side of that equation. What do you actually do when you win? Because if you stay invested long enough, eventually you cross the finish line and become wealthy. Now, even though I don't think you should be flashing your money, let's be honest. There are going to be signs. Like for me, maybe I'll be driving around in a Lamborghini somewhere on the beach. Or maybe when Bitcoin finally hits $1 million, I'm not going to tweet about it, but I might be in the Oval Office shaking the president's hand, or flying somewhere random on a Tuesday on my private plane. Actually, realistically, I'd be flying to Bali, where I'll be relaxing and working on Higgsfield.ai, which is the sponsor of today's video. And it is actually what I used to create all of the visuals you're seeing right now. It is an advanced AI image engine powered by Google's Gemini 3 Pro image model. What makes it so different is that it's not just about making pretty pictures. It actually understands structure, text, and realism. I had so much fun with it because it can generate clean, cinematic 4K images of scenarios like cities, travel, cars, and environments. It even handles ads and thumbnails without the usual AI hallucinations like broken text, warped faces, or weird hands. Right now, Higgsfield is offering unlimited Nano Banana Pro generations for the entire year if you sign up by the deadline. It is currently one of the most affordable pro-grade AI platforms out there. I'll put the link in the description if you want to check it out. Thanks to Higgsfield for sponsoring this segment. And now, let's get back to the geopolitical chess game. For most of its modern history, China's economy actually ran on silver, not gold. China's taxes were paid in silver. Big transactions were all settled in silver. Even their trade balances were denominated by weight in silver, not necessarily by face value. So for a long time, silver wasn't just a commodity. It was China's sovereign money. And because of that, China became one of the biggest consumers of silver the world has ever seen. From the 1500s all the way through the 1800s, massive amounts of the world's silver flowed into China. If you wanted access to China's production, because remember, China was and still is the factory of the world, silver was the only currency they would accept. But what is important here isn't just that silver was money. It was the anchor that stabilized their entire economy. It stabilized their incomes, their prices, and their tax revenue. And for centuries, it worked. But there was one fatal flaw. And that flaw was ruthlessly exposed in the 1930s. In 1934, the United States passed a piece of legislation called the Silver Purchase Act. It forced the U.S. government to aggressively buy huge amounts of silver on the open market. What that did was send the global price of silver skyrocketing. Now, for a country like China that is based on a silver monetary system, that was actually catastrophic. As silver prices went up globally, arbitrage traders realized they could sell Chinese silver abroad for a massive profit. Silver began to hemorrhage out of China. The literal money supply started to leave the country. The capital that was supposed to be used to fund their economy vanished. And what that looked like on the ground was immediate economic collapse. The price of goods started to crash. This is called deflation. Now at first you might say, wait, isn't that a good thing? Prices going down? And sure, it sounds good for a week. But in the long run, deflation is a death spiral. It means people start to expect prices to fall further, so they stop spending. They stop investing. Businesses stop hiring. The economy starts to eat itself alive. Because if you know that the house or the car you want to buy is going to be worth half as much tomorrow, why would you ever buy it today? You wouldn't. You would wait. And when you multiply that behavior across millions of people, you get a depression. That is exactly what China got. So, in response to all that chaos, in 1935, China officially abandoned the silver standard and moved to a paper currency system. Now, they didn't do this because silver failed them as money. They did it because China learned a very painful, very useful lesson, which is the entire point of this video. What they learned is that if your economy depends on a critical material that you do not control, other nations can and will weaponize that market against you. That is a lesson that the Chinese leadership never forgot. And when you look at what China is doing today with silver, everything starts to make a lot more sense. So the question is, what exactly did they just do? And what are they doing right now? This is a masterclass in the global game of geopolitical chess. What they did was reclassify silver under the dual-use export control rules. This is significant. It means a material that is used for civilian purposes, like jewelry or silverware, is now legally designated as something that can be used for military and strategic purposes. And once something falls under that category, exports are no longer automatic. Instead, every single shipment is going to need explicit government approval. It is very smart politics, because if China simply came out and banned silver exports, like they ban Bitcoin every few years, that would create immediate diplomatic backlash. A total ban would force the US president and trade partners to retaliate with sanctions. But by relabeling it as strategically important on paper, China can simply shrug and say, "We are not banning silver. We are not attacking anyone. We are just updating our internal compliance regulations." Now, of course, in practice, their rules are written so specifically that almost no one is going to qualify for these export licenses. Only the massive state-affiliated producers will even be considered, and even then, approvals are going to be completely at the mercy of the state. And by doing that, they are effectively closing an open market and starting to gatekeep the resource. This matters because China is sitting right in the middle of the global silver supply chain. This strategy gives them massive leverage because you have to remember, most silver is not mined on its own. It is produced as a byproduct when companies mine for other base metals like lead and zinc. And once that raw ore is out of the ground, it has to be processed. It has to be refined and separated to be useful. And a huge percentage of that refining capacity happens inside of China. So even if silver is dug out of the ground in Mexico, Peru, or Australia, there is a very good chance it still passes through Chinese infrastructure before it ever becomes a usable industrial metal. And now, starting on January 1st, the Chinese government gets to decide whether that metal leaves their borders or stays. Now, what is fascinating about all this is that this isn't even China's first time running this playbook. Over the last 10 years, China did the exact same thing, but with rare earth elements. Today, China maintains a chokehold on roughly 80 to 90% of global rare earth refining. Why do rare earths matter? Because you cannot build an F-35 fighter jet, an electric motor, a wind turbine, or precision-guided missiles without them. In the early 2010s, China reclassified them as strategic. They implemented strict export quotas and licensing rules. The result was that prices went parabolic, and Western governments panicked. Only then did the US, Europe, and Japan realize that they had outsourced their entire supply chain. They realized that rebuilding their own refineries was not a short-term fix. In a lot of cases, it took more than a decade just to partially rebuild non-Chinese supply chains. So, what we are seeing in silver today is the exact same economic weapon that was used with rare earths, but with one major terrifying difference. Silver is not a niche specialty metal. It is used in everything. But the problem for the West is magnified because of how silver supply reacts to price. Roughly 70 to 80% of the world's silver production comes as a byproduct. That means even if silver prices doubled tomorrow, the production does not automatically increase. You can't just mine more silver. You have to mine more copper, lead, and zinc to get it. This creates a phenomenon that economists call inelastic supply. Now, what does that actually mean in plain English? Think of it like this. If coffee doubled in price tomorrow, you might be annoyed, but you would probably just start drinking less coffee or switch to tea. That demand is elastic. It stretches and shrinks based on the price. But if insulin doubled in price, diabetics would still buy it. They have to. They need it to survive regardless of the cost. That is inelastic. It is rigid. The demand does not drop just because the price goes up. Silver is effectively the insulin of the industrial world. Apple cannot build an iPhone without it. Tesla cannot build a Model 3 without it. And because it makes up such a tiny fraction of the total cost of the car or the phone, they will pay whatever the price is to keep the factory running. So with all of this context, look at the timeline. China is setting up a January 1st, 2026 start date for the full implementation of these export rules. And that is why we are seeing this rush right now. China has been quietly securing as much silver as possible, winning the contracts and locking in the supply, while foreign buyers are suddenly realizing they are exposed. So the billion-dollar question is, what happens now? And I want to be very clear here. This is not a silver price prediction video. I do not know where silver is going to be next month, next year, or 3 years from now. And frankly, neither does anyone else on YouTube. But we can look at history for clues, because silver has a very specific personality. For most of its history, silver is incredibly boring. It doesn't move. It just kind of sits there for years, sometimes for decades, doing absolutely nothing, while the stock market rallies. But then when the fundamentals shift, silver has a habit of moving violently fast. And that is because, remember, the industries that need it do not have the luxury of waiting it out. When the shortage hits, the panic buying starts. This has happened before. In the late 1960s and 70s, silver doubled more than once. Then, in the famous run from 1979 into 1980, it went from roughly $6 an ounce to over $50 an ounce in just over a year. That is a nearly 800% move. But you have to remember, silver acts very differently than other financial assets. When stocks get too expensive, investors just stop buying them. When bonds look unattractive, the money moves to cash. But when silver becomes physically hard to find, factories don't just stop their production lines. Governments don't shut down their defense contractors. They bid the price up. So the price goes way, way up, very, very fast. And that is usually when the second wave hits, the speculators. That is when the retail investors and the hedge funds jump on board, and you see an even bigger vertical price spike. And that part is the speculation phase. But we have to be honest about what happens next. After those massive spikes, silver almost always corrects and crashes back down. It doesn't crash because the world suddenly needs less silver. The factories still need it. It crashes because the speculative, hot money that flooded in starts to leave. The smart money takes their gains off the table, sells their silver to the latecomers, and moves that capital somewhere else. Once the leverage and the excitement get flushed out, or once the retail traders get margin called, prices can collapse just as fast as they went up. Which is my very complicated way of saying, I have absolutely no idea where we are in this specific journey. Are we still in the first phase where the price is just honestly catching up to the fundamental reality of a supply shortage? Or are we already in the speculation phase where YouTubers start making viral videos about this and the price disconnects from reality? I don't know. Some people say silver is finally just waking up. Others say, be careful buying here because you might be buying the top. But what we do know for sure is that markets move in cycles. Once a correction happens, that capital doesn't just disappear. It rotates. It looks for the next asset where the upside hasn't been realized yet. Sometimes that rotation goes back into equities and the stock market. Sometimes it flows into energy sectors. Sometimes it moves into emerging markets. And in the most recent years, we have seen it flow into digital hard assets like Bitcoin. We have had the run in gold. We are seeing the run in silver right now. We have had the massive run in tech and AI. Because investors are always hunting for the next rotation, that money will eventually leave the silver market too. But whether silver goes to $100 or crashes back down to $50 isn't actually the most interesting part of this. The most interesting thing is that this isn't really a story about silver prices at all. It is a story about a critical shift at the crossroads of money, power, industry, and technology. China learned this lesson about silver the hard way almost 100 years ago, when the market was weaponized against them. And today, we are watching them apply that same lesson, but in reverse. The strategy is simple. Control everything. Control the mining, control the processing, and control the exit. That is exactly what the BRICS nations are trying to do. They are trying to build trust in money again using gold. They are decentralizing the custody of that gold using the new gold corridor. And they are locking down control of the raw materials that the modern world cannot function without, specifically silver and rare earths. If you do that, you don't just influence the price of a commodity. You influence who gets to build the future, who has to wait in line, and who has to come asking you for capital to fund their economy. That is called leverage. And leverage is the most important currency in a world that is moving away from cooperation and globalism. It is what economists call a multipolar world, A world where it is not just one country that gets to make all the rules and control the global reserve currency. It's not going to be just the US anymore, and silver is essentially the next domino to fall in this massive restructuring. But I would love to hear your thoughts. Do you think this supply crunch is real, or is it just another hype cycle? And where do you think that capital will flow next? Let me know down in the comments below. As always, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next week, and I'll see you soon. Bye-bye.